All right, let's get right into it. If you're a contractor, you know that your heavy equipment, well, that's the heart and soul of your business. But financing that gear, it can feel like you're trying to find your way through a maze in the dark. Today, we're going to turn on the lights. This is your guide to getting the financing you need, not just to keep the doors open, but to really grow. I mean, think about it. Whether it's a dozer on a job site, a feller buncher out in the woods, or a combine in the field, this is what makes your business go. Without the right machinery, everything just grinds to a halt. You miss out on jobs, and you can't grow. It's that simple. And that's exactly why this is such a big deal. You're not just buying a new toy here. This is a massive strategic decision, and it affects every single thing you do, every single day, from hitting your deadlines to keeping your crew busy. So, here's the classic dilemma, right? You know you need that new machine to take on bigger jobs and to be more efficient. You can see the path forward. But standing right in the middle of that path is the loan process itself. It feels like this huge roadblock, and sometimes it seems just as tough as the job itself. You're just swimming in all this jargon and fine prints. You're trying to make sense of interest rates, what the repayment terms really mean for your bottom line, and if you even check all the boxes for the lenders. It's a lot. But here's the good news. You're not stuck. You just need a better map. Okay, so where do you even begin? Well, your first big choice really comes down to two main doors. You've got the traditional route, your banks and credit unions, and then you have the more modern path, these alternative lenders. And trust me, each one is a very different journey. Let me paint a picture for you. Think of a bank like a giant, steady cargo ship. It's super reliable, and the cost to ride is low. But man, it takes forever to get going, and there's a mountain of paperwork just to get on board. Now, alternative lenders, they're the speedboats. They'll get you where you need to go, like now, zipping around obstacles, but you're going to pay a whole lot more for that speed. And this chart really lays it all out, doesn't it? If your credit is in great shape, banks are going to reward you with lower rates and better terms. But look at the approval speed, slower. Now, flip over to the other side. If you need cash fast or your credit has a few dings, alternative lenders are your go-to. Their whole game is fast approvals, but that speed comes at a cost, and you'll see it in the higher interest rates. It's the classic trade-off, speed versus cost. So what's it going to be for you? The slow and steady cargo ship? Or the fast but pricey speedboat? And while you're mulling that over, based on your timeline and your finances, there's another really powerful move you can make, one that uses what you've already got. Let's talk about a savvy strategy that, honestly, a lot of business owners just completely overlook. It's all about tapping into the value, the equity of the equipment you already own. We're not talking about getting a loan for new gear. This is about using your current assets to put your business in a much stronger financial spot through refinancing. So what is it? It's actually pretty simple. You're basically just trading in your old equipment loan for a new one. You use the same machine as collateral, but the whole point is to get a way better deal. Maybe that's a lower interest rate, a smaller monthly payment, or even pulling some cash out of the equity you've built up. And the process itself, it's not as scary as you might think. It all starts with figuring out what your equipment is worth today and taking a hard look at your finances. From there, it's pretty straightforward. You apply, get matched with a lender, get the green light, and close the deal. The payoff? More cash in your pocket each month, or a fresh injection of capital to grow your business. And this is the real kicker, right? This isn't just moving money around for the sake of it. This is a strategic move. You can free up your cash flow, which gives you more breathing room. You can get that capital you need to finally jump on that expansion project. You're basically turning that piece of metal sitting on your lot into a powerful financial tool. Okay, so whether you're going for a new loan or refinancing, the big question is always the same. How do I get approved? So let's shift gears from the what to the how. How do you put together an application that a lender just can't say no to? You got to think like a lender for a minute. When they look at your business, they're basically weighing risk in three different buckets. There's industry risk, stuff they can't control. But then there's your business risk and your financial risk. And that is where you have all the power. First up, a number you absolutely need to know, your debt to equity ratio. In plain English, it just shows how much of your business is paid for with debt versus your own money. If you can keep this number under 2 to 1, you're sending a crystal clear message to the bank, hey, I'm not drowning in debt. I've got my own skin in the game. And that gives them a ton of confidence. And here's another one. Think of this as your business's pulse. It's a super quick check. Do you have enough cash and other current assets to cover your immediate bills? If this number is greater than 1, it tells a lender, yep, we can pay our bills this month, no sweat. It's the absolute baseline of financial health. Now, let's talk about dealing with your banker. This is all about building trust. And here's your cheat sheet. Get a line of credit before you're desperate for it. Know your financial statements backward and forward. Bring your accountant to the big meetings. They speak the bank's language. And probably the most important thing, be transparent. Hiding a problem is the fastest way to get a no. Being upfront about it and showing them you have a plan, that shows you're a pro. You know, it's easy to feel like getting the loan is crossing the finish line, but really, that's just the starting gun. The real win, the long game, is all about managing that debt smartly so your business is stable for years to come. It's about building something that thrives. And what happens if things get a little tight and the debt starts to feel like a heavy weight? First off, don't panic. It's not a sign that you've failed. It's just a signal that you need a new game plan. There are smart, structured ways to get back on solid financial ground. So, what are your options? Let's look at 3 big ones. Debt consolidation can make your life way simpler by rolling a bunch of payments into just one, and you can often snag a lower interest rate. Credit counseling brings in a pro to help you map out a realistic payment plan. And a consumer proposal is a formal, legal path to negotiate with your creditors that lets you avoid bankruptcy. Each one is a tool to help you get back in control. So as we wrap this up, it all comes down to this one final question. Everything we've talked about, every loan, every ratio, every conversation with a lender, it's all pointing to this. Are you building a financial strategy just to survive, just to make it to the next job? Or are you deliberately building an engine designed for real sustainable growth? The tools, as we've seen, are all right there for you to use.